students. I am Ashok Kumar Aggarwal, Academic Counselor IGNOU. Today we are going to study MMPC 014 Financial Management, Block 1 Financial Management and Overview, Unit 1 Financial Management and Introduction. Now every business, you see, without finance, you see, it cannot run. So finance plays a very important role, like there is human resource, you see, management, then marketing, then production. All these departments are very important. Just like these departments, finance department is also, you see, very important. Every business organization, irrespective of its size, requires a sound and effective financial structure. You see, without money, you see how production will start. You see, money is required at every stage for operations. Various activities such as production, marketing, human resource management and finance must be carried out efficiently to achieve the organization's goals. The main goal of the organization is, you see, to earn the profit. Among these, you see, finance holds a unique and vital place. Finance is often referred to as lifeblood of a business, because all other business functions depend on the availability and management of funds. Now every company, they will have a you can say general manager finance or funds manager, you see, from where company will be, you see, getting the funds and which are the payments which company has to, you see, meet out. So his main duty is this only, you see, managing the funds. Finance ensures the acquisition and utilization of monetary resources, you see, needed to run daily operations. For daily operations now, you see, raw material, then labor payment, then your electricity, cartage, all these, you see, money is required for making payments of these current, you see, liabilities, and so that production, you see, takes place, you see, without any, you see, there is no problem in the production. So finance ensures the acquisition and utilization of money resources needed to run daily operations, invest in long term projects and meet emergencies. Without adequate finance, you see, every profit generating businesses may not survive in the long run. If, you see, funds are not there, then you will have to close down the business. Now for these funds, you see, you can approach a bank, financial institution, you can raise the money if it is a company, by public limited company, by issuing their shares. So it is also crucial before the business starts, you see, operations, as finance helps assess the feasibility of ventures and ensures the firm's economic viability. If any, you see, organization, we say it is technically feasible and economically viable. What is its meaning? That it will earn, you see, profit. By seeing the unit, you see, it appears that it will earn, you see, profit. Now next is, the finance function plays a dual role. On one hand, it facilitates the availability of funds, you see, how the funds are, you see, will come. On the other hand, it ensures their optimum utilization, you see, then you have to use those funds also to generate, you see, returns for the business and its shareholders, you see. Thus, understanding the meaning, nature, scope and significance of financial, you see, management is essential for long term business, you see, sustainability and growth. Now if you approach a bank also for, you see, funds, normally bank sees, you see, past 3 years sales and, you see, future year 3 years projections. You see how much are your sales going to be in future. Suppose a company is expecting, you see, 1 crore sale by, you see, say now March 26, only 6 months are remaining, half of the year is over. Then bank can, you see, finance up to 20% of the sales, you see, 20 lakhs bank can give to the company as working capital limits. Working capital limits means money required for buying raw material, paying the rent of the factory, making payment to the labor, electricity bill, water bill, all those expenses which are, you see, required for doing production. Now, this is one type of, you see, finance. Another type of finance is, you see, you have to suppose buy land, building, or construct factory premises, or buying machineries, you see, fixed assets. If you acquire fixed assets, for that also bank gives, you see, a loan. If you are already having, you see, fixed assets, then you will apply only for working capital limits. Just now which we discussed, that bank can give working capital limits up to 20% of the sales. Other type of borrowings, you can, you see, borrow from the, you can purchase. If you are having bills, bank will purchase your bills. If you are having bills, bank will discount your, you see, bills, and you can get, you see, quick realization. You see, quick realization you can, you see, get. And working capital limits, they are against hypothecation of stock, hypothecation of book debts. You see, if you, in every business they sell the goods on credit, so those your book debts, those, you see, debtors, against those debtors bank can give you finance. Then you can, you see, issue shares by debentures. You can borrow money by issuing debentures. A company can do that. Now, the finance function is primarily concerned with the process of, you see, planning, acquiring, managing, and controlling a firm's financial resources. You see, from resources means from where firm is going to get the money to achieve its business, you see, objectives. It involves decisions on how to raise funds, how to deploy them after getting the funds, where to use them, deploy them, and how to manage them in such a way that they contribute to wealth creation. You see, the essence of the finance function lies in making rational and prudent decisions, you see, regarding the procurement and utilization of funds. Traditionally, the finance function was seen as a clerical job limited to routine activities such as keeping accounts, you see, bookkeeping, you see, and most of the, you see, firms, they follow double entry bookkeeping, managing cash flows, you see. However, modern finance has evolved into a strategic managerial function that impacts almost all area of a business. The finance function can be categorized into two broad types: routine and managerial. Now, routine functions are operational and clerical in nature. These include the supervision of cash receipts and, you see, disbursements, safeguarding financial, you see, documents, managing insurance and securities, and ensuring proper, you see, record keeping and reporting. While important, these tasks do not require high levels of, you see, managerial expertise. Suppose stocks are there, you see, then the company, they have to get them insured. If suppose fire takes place, then if the stocks are covered, you see, by a insurance policy, then insurance company will pay if there is a, you see, fire. And you see, under that, raw materials, goods in process, finished goods, all these, you see, plus one gets the insurance of fixed assets also, like machineries, you see, machineries insurance also. Suppose anything, you see, if the machinery also during fire, machinery also is, you see, destroyed, then you will get the money from the insurance company. So Now cash receipts, you see, money you see collected by means of you see payments or checks also you see pay. The people to whom you have sold the goods, they will give you checks also, they will give you cash also. In now these days they remit the money through IRTGS, NEFT, you see, by their mobile phone they will you see make the payments. Then insurance, just now we have covered insurance and securities. And then you see accounts, keeping the you see accounts, of course they are all on computer also, but you see accounts of the people with whom you deal, you see your suppliers, your customers, those who buy goods from you, so their accounts you see, you have to they are maintained, and proper recording of all the transactions are done. Sales book, purchase book, you see, cash book is day book or cash book is you see prepared. You see these tasks, you know, just now which we discussed, they don't require high levels of managerial expertise. Only you see those who are assistants or you see at clerical level, they can also you see do these jobs. So these are routine functions. Now what is the other type? Other type is you see finance function, other type is you see managerial function. Now on the other hand, managerial functions are strategic and involve critical finance decision. These include raising capital, you see, whether you will be issuing you see shares, new shares will be issued, determining capital structure, you see that capital, how much, what percentage will come through you see shares and how much from other sources, you see, allocating funds among various assets, you see, then managing risk and taxation, and dealing with you see cost control, you see, dealing with cost control is you see it is very important, you see. Now these functions demand analytical skills and are closely tied to achieving the long term financial health of the you see firm. Now we take the example of a bank branch, you see, people deposit money in this. Depositors, they are having saving bank account or fixed deposit accounts. That particular branch you see lends money to the borrowers, whosoever you see needs money, he can approach the branch. Suppose you need car loan, if you are eligible, then they will you see sanction you and disburse you housing loan. If you are eligible as per the rules and regulations of the bank, they will give you housing loan. Housing loan goes for 20 years, 25 years, 30 years. Now the funds which the branch has received as deposits, if the branch does not lend money, then you see how branch is going to pay interest to the depositors, you see. So those deposits are to be deployed, you see, they are to be deployed. So like that is how a branch you see, bank branch runs, paying interest on deposits, and you see on advances it charges a little you see higher rate of interest. That difference between deposits interest rates and advances interest rate, that is the profit for the you see branch. So what we are trying to say in this particular slide is, so those funds the bank branch you see deploys means uses them as a loan. Now in a bank branch, in savings bank account, bank is hardly paying 3% interest, but same money bank is using you see as loans for giving you see loans. Their bank is charging 11%, 12%, 10%. Similarly in current account, bank is not you see giving any interest, but minimum balance in current account they say 10,000 rupees, you see most of the bank. So now suppose in one particular branch 100 you see current accounts are there, or 500 current accounts are there, and 10,000 you see minimum balance is there in every account. So 500 into 10,000, it means you see this much amount you see bank is always bank will have, because these minimum deposit customers will not you see withdraw. They will have you see bank will have much more you see money, but this minimum amount which bank always will have will be used by the bank for giving loans. Their bank will be charging 10%, 12%, and on these deposits bank is giving just 0% interest to the customers. So that is how you see bank makes the profit. Now there are two primary approaches to understanding financial management: the traditional approach and modern approach. These approaches differ in terms of scope, orientation and role of financial managers. The traditional approach to financial management, which prevailed until the 1950s, viewed finance as a narrow discipline focused primarily on the process of raising funds for business needs. It concentrated on procurement of funds through external sources, like banks, investors and financial institutions, and gave little attention to internal use of funds. Much attention was not paid, how these funds were to be used internally. Now financial management undertake this approach. Under this approach was often synonymous with corporate finance and was largely concerned with events like mergers, acquisition, restructuring and liquidation. Now mergers, say we take the example of banks. Government of India is merging banks. Suppose one small bank is going in loss, so Reserve Bank will merge that bank with a big bank, say State Bank of India, by following the procedure, taking approval from the government. Then same way restructuring. Suppose a borrower, heavy limits he has got from the bank, still he is not in a position to run his business, not earning much profit, so they will he will be asked for restructuring of the advance, in which they will give him more time, moratorium they can give him, and suppose he was to repay in 3 years, now they can ask him to repay in 5 years, bank loans. Some restructuring they will do of the limits enjoyed by that borrower. Then acquisitions and liquidation. Traditional approach. This approach had several limitations. This approach had several limitations. Firstly, it considered finance from the viewpoint of external stakeholders rather than internal decision makers. Secondly, it focused on rare and episodic events instead of everyday financial operations. Thirdly, it ignored important areas such as working capital management, cost analysis and internal controls. Consequently, the traditional approach failed to address the core financial issues faced by businesses on a day-to-day basis. Now, working capital management, normally working capital is your current assets minus current liabilities. In the other slide we discussed that bank can sanction working capital limit of 20% of the sales, projected sales. Suppose your sales are going to be 1 crore this year, so bank can give you 20 lakhs working capital limits. By these limits you can buy raw material, make payment to laborers, then rent, then electricity bill, other expenses, daily expenses. they will open a cash credit account. Bank will open a cash credit account. Cash credit account is just like a current account. Current account, you have to deposit your money. In cash credit account, bank will give a limit of 20 lakhs. You can borrow from this account, you can withdraw maximum 20 lakhs, and tomorrow you can repay also if you are having money. Then again, you see the balance amount you can withdraw. Whatever you have repaid, you can again withdraw. So at any point of time, your borrowing from the bank should not be more than 20 lakhs in this account. This is just like a current account. So if you get payments, you deposit those payments in this account. Those checks you deposit. If you want to make payment, you issue checks from this account. So this is a running type of, you see, account known as cash credit account, and concerning your working capital, your day to day, you see, expenses plus the payments when you receive, you will, you see, deposit those payments in these accounts. So working capital, you see, you have to, just now we discussed, you have to, you see, you can take loan limit from the bank, and the method is, you see, this only. You see, current assets minus current liabilities is your working capital, and banks, while sanctioning working capital limits, they just see the sales. If the projected sales are 1 crore, they can give you 20 lakhs limit as working capital. The modern approach which emerged, you see, post 1950s, expanded the scope of financial management significantly. It views financial management as an integral part of the overall business management. This approach emphasizes the efficient and effective use of financial resources and includes all aspects of financial planning, control, and decision making. You see, it recognizes that finance decisions have a wide ranging implications on the profitability, risk, and value of the firm. You see, so you have to deal it very carefully. Finance decisions you have to take very, you see, carefully, and because they will have effect on your profit. If you have, you see, borrowed the money where you have to pay huge amount of interest, then naturally your profit will reduce. If you have borrowed the money where you are paying less rate of interest, your profit will increase. You see, the modern approach categorizes, you see, financial management into 3 primary decision areas: investment decisions, that is capital budgeting, where you have to invest; financing decisions, capital structure, you see, you have to obtain money from where; and dividend decisions, you see, some portion of the profit you will pay to shareholders, that is dividend, you will give them dividend. Every year, you see, company gives dividend to the shareholders. And the next para is the modern financial manager is responsible not only for raising funds. He is not responsible only for raising funds. Of course, he has to raise funds, but also for determining the most beneficial ways to utilize them. You see, he has to utilize those funds in the, you see, best possible way to increase the profit of the, you see, company. The goal is to maximize the firm's value and wealth for shareholders. If their share price increases, they will be happy, you see. This approach is analytical, comprehensive, and aligns finance with overall business, you see, strategy. Major financial decisions, you see, a firm's financial decisions are crucial because they directly influence the market value and profitability of the organization. These decisions, you see, revolve around how funds are raised, how they are invested, and how profits are allocated. There are 3 major financial decisions in any, you see, firm. The investment decision pertains to the selection of assets in which the firm should invest its funds. These decisions can be divided into two types: long term investment decisions, you see, capital budgeting, and short term investment decision, working capital or liquidity, you see, management. The liquidity of the firm, liquidity condition should be such, you see, at any time, you see, if any they have to pay to the creditor, you see, amount is due, it should be in a position to, you see, pay. Say for example, banks assets and liabilities. Banks assets are banks loans, banks liabilities are deposits kept by the people in the bank branch. Now they manage asset liability management, they manage the assets and liabilities in such a way that if any depositor comes and if his deposit is maturing, bank should be in a position to pay his money with interest, with his principal plus interest. Bank should not say that you see we cannot pay because our liquidity, you see, some liquidity problem is there is no money. Not bank cannot say like that. So they are managing their assets and liabilities in such a way that, you see, the liquidity position is, you see, sound, strong. If any depositor's deposit is maturing, bank should be in a position to give, you see, money on the maturity date of the fixed deposit to the depositor. Now next is capital budgeting, involves, you see, choosing among various long term investment opportunities based on expected future benefits. Since these returns are realized over a period of time, techniques such as present value and internal rate of return are used for evaluation. Present value, suppose any investment, you see, after 2 years you will get, you see, 1 lakh, but what is its present value today? You have to calculate that. And internal rate of return, IRR. Now suppose, you see, you have given a loan, bank has given a loan, car loan to a, you see, borrower at, you see, 10%, rate of interest is, you see, 10%. Then bank charges some processing charges also every year, you see, say 1%. So what is the internal rate of return in this particular case is 11%, 10% plus 1%. Now investment decision, these decisions are complex due to the risk and uncertainty associated with future, you see, cash flows. Liquidity decisions deal with the management of, you see, current assets and liabilities. A firm must maintain adequate liquidity, you see, to meet short term, you see, obligations, short term liabilities, you see, it should meet out. So its liquidity position should be good, while also ensuring that excess funds are not idle, you see, funds should not be idle, also excess, they should be invested. Striking the right balance between liquidity and profitability is essential for operational, you see, efficiency. Financing decision, once investment decisions are made, the firm must decide how to finance these investments. The financing decision relates to determining the optimal, you see, mix of equity and debt in the capital structure. A sound capital structure minimizes the cost of capital while maximizing the value of the firm. The financial manager must assess the cost, control implications and risk associated with different sources of finance. The objective is to achieve a balance where shareholder wealth is maximized without exposing the firm to excessive, you see, financial risk. What a shareholder wants, he wants that the price of his share, you see, increase, number one. Number two, dividend, every year he wants dividend, good amount of dividend, you see, good percentage. The dividend decision involves determining the portion of profits to be distributed to shareholders versus the portion to be retained for reinvestment in the business, you see. A good dividend policy must maintain a balance, you see, between rewarding shareholders and retaining earnings. Retaining earning means, you see, re-employment of the, you see, that portion of the profit which is not given to shareholders as dividend, that portion of the profit reinvested in the firm. The impact of dividend decisions on share price, investor satisfaction and firm's reputation must be considered. The goal is to choose a policy that enhances shareholder value over time. The fundamental objective of a business enterprise is to maximize the economic benefit for its owners, that is the shareholders. In the corporate structure, shareholders are the owners and management is entrusted with the responsibility of running the business. Therefore, management decisions should ideally align with the objective of the shareholders wealth maximization. So, management's decision should be such that the shareholders wealth is increased, share price is increased. Two major objectives have been proposed in financial theory: profit maximization and wealth maximization. Profit maximization implies that the firm should undertake activities that increase its profits and avoid those that reduce them. Suppose any one particular item sale is less, naturally the firm will start producing that particular item in less quantity, and one particular item sale is more, firm will increase the production of that particular item. So, it is an intuitive and straightforward goal. However, this approach has several limitations. Firstly, profit is a vague term and can be interpreted in many ways, that is gross profit, net profit, operating profit. From the operations, this is the profit, then net profit after paying all taxes etc., net profit. Secondly, it does not consider the timings of returns. Early returns are more valuable than later ones due to the time value of money. Now, if you have sold the goods on credit, after 1 month if you received one payment, and one payment you received after 5 months, so the one which you received after 1 month, that is better. Thirdly, it ignores the risk factor associated with various investment opportunities. It assumes certainty in future earnings, which is unrealistic in a dynamic business environment. Moreover, profit maximization may lead to unethical practices or excessive risk taking in pursuit of higher return. Suppose you have taken more risk and instead of profit you suffer loss. It does not ensure long term sustainability or stakeholder satisfaction. Therefore, profit maximization is now considered an inadequate and outdated financial objective. Wealth maximization. Wealth maximization, also known as value maximization or shareholder value maximization, is a more comprehensive and acceptable financial goal. It aims to increase the net present value of a firm's future cash flows, thereby maximizing the market value of share holders equity. This approach considers the quality, timing and risk of returns, making it superior to profit maximization. Wealth maximization emphasizes the use of financial tools such as discounting, cost of capital and risk return analysis to make informed decisions. It supports sustainable growth and long term profitability. Moreover, it aligns with the broader corporate responsibilities such as employee welfare, environmental protection and social contributions. Now, employee welfare, so many companies you will find they give tiffin allowance, it is a part of salary only. Then they take health insurance policy of all the employees, You see, some amount they deduct from their salary and remaining they pay as premium to the insurance company. Similarly, so many other you see benefits. You see, they will have holiday homes for the employees if they want to go out and you see take some holidays, so they will provide them holiday homes. You see, so many you see facilities now they are you see giving. Therefore, wealth maximization is the central guiding principle for modern financial you see management. Risk return trade off, you see, all financial decisions involve a trade off between risk and return. The more risk you will have, the more return you can get. Higher returns are generally associated with higher levels of risk. This relationship is fundamental. It is risk is directly related to you see return. This relationship is fundamental to investment and financial decision. Investors demand a return that compensates them for both the time value of money and the risk associated with a particular investment. You see. Financial managers must evaluate you see various opportunities by analyzing their expected returns and associated risks. The goal is to achieve an optimal balance that maximizes shareholder value while you see maintaining an acceptable level of risk. This principle is particularly important in portfolio management. Portfolio management means you see capital budgeting and capital structure decisions. Portfolio management means suppose you see you are having say 15 investments. All your portfolio is consisting of 15 investments, and you see you have invested in bank, you have invested in post office, you have invested in shares, you have invested you see at many places you have you see invested. So this is your portfolio. This is your portfolio. In the portfolio, some investment should be you see say like investment in the bank. Though it will not pay you more interest, but it is very safe. Your principal will not go anywhere. You invest in shares, tomorrow the value of shares goes down, your principal will reduce, you see. Financial goals and you see broader business objectives. While maximizing you see shareholder wealth is the central financial objective, firms also pursue broader goals related to their vision, mission and social responsibilities. These include providing you see quality products and services, you see, achieving technological excellence, maintaining employee welfare and contributing to you see society. A firm must balance the economic interest of owners with the expectations of other stakeholders such as you see customers, employees, creditors, regulators and the community. Financial decisions must be you see ethically sound and socially responsible. Thus, wealth maximization should be viewed not in isolation but as a part of broader you see commitment to corporate you see sustainability and stakeholder you see welfare. In a joint stock company, there is a you see separation between ownership and management. This creates the potential for a conflict of interest known as the principal agent problem. Managers agents may pursue you see personal goals such as job security, power or prestige rather than you see shareholder wealth maximizations. This conflict can lead to inefficiencies and suboptimal you see financial decisions. However, such managerial behavior is constrained by various internal and external controls. Shareholders can influence management through voting rights, board supervision, audits and performance you see evaluation. The competitive you see market and regulatory bodies are also ensure that managers are you see accountable for their decisions. Alignment of managerial incentives with shareholder interests such as through performance based you see bonuses or stock options can reduce such conflicts. Now in so many companies you see they will give to their best performing employees, some they will give them some shares, you see, they give. Organization of the, you see, finance function. The structure of the finance function varies depending on the size and complexity of the firm. In large organizations, the finance department is a major functional area headed by a finance director or chief financial officer who reports to the board of directors. Under the chief financial officer, the department may be divided into specialized roles such as controller and treasurer. The controller oversees, you see, accounting, budgeting, internal audits and financial reporting. The treasurer handles, you see, capital raising, investor, you see, relations, cash management and risk management. Each role plays a strategic part in ensuring the firm's financial stability and compliance. The organization of the finance function ensures that, you see, financial planning, control and reporting are conducted in a systematic, you see, and integrated manner. It also ensures that legal, regulatory and ethical, you see, standards are maintained. The finance manager plays a crucial role in both strategic and operating decision making. Their responsibilities include estimating capital requirements for objects, maintaining liquidity and solvency, managing relations with financial institutions and evaluating financial risks. They are also responsible for credit policy decisions, internal controls, compliance with financial, you see, laws and setting the firm's, you see, dividend policy. Taxation also, you see, they have to pay taxes in time. The finance manager must balance profitability with risk, short term needs with long term growth and shareholder interests with corporate social responsibilities. In doing so, they contribute directly to the overall, you see, financial health and strategic direction of the firm. Financial management is closely linked with the several other disciplines, particularly accounting and economics. While accounting provides the data and records necessary for, you see, financial decision making, say profit and loss account, balance sheet, finance interprets and uses that data to, you see, make strategic choices. Accounting is based on accrual principles while finance emphasizes cash flows and timing. Economics, you see, provides the theoretical foundation for financial decision making. Concepts such as marginal and opportunity cost and market equilibrium are essential for evaluating investment and financing, you see, alternatives. Financial management also draws from areas, you see, like statistics, operations, marketing and strategy to ensure well-rounded, you see, business decisions. Financial management is essential for planning, acquiring and utilizing funds to ensure a business profitability and sustainability. The unit explains the evaluation from a traditional focus on fund raising to a modern approach that includes investment, financing and dividend decisions. It emphasizes wealth maximization as the key objective, considering risk and time value of money. The finance function supports, you see, broader business goals and must balance the, you see, interests of shareholders and other, you see, stakeholders. The finance manager plays a, you see, strategic role, and financial management is closely linked with accounting and economics. Now we come on the unit 2, that is time value of money. The fundamental principle behind the concept of time value of money, TVM in short we write, is that a rupee received today is more valuable than a rupee received in the future. A rupee received today is, you see, more valuable than a rupee received in future. This is due to several reasons such as the ability to invest and earn interest on money today, uncertainty about the future, inflation and the loss of purchasing power over time. For instance, if someone offers you 75,000 today or 1 lakh after 5 years, the instinctive decision would often be to accept rupees 75,000 now. That's because money in hand today can be invested and grown, whereas the future is uncertain and inflation will likely reduce the real value of 1 lakh after 5 years. The time value of money is not just a theoretical concept but a practical tool used extensively in financial decision making. Whether it is an investment appraisal, retirement planning or loan analysis, the time dimension of money plays a central role. Understanding and applying this concept correctly allows individuals and businesses to make informed choices among various financial alternatives that involve cash flows occurring at different points in time. The future value of money refers to the value of a current amount at a future date. The future value of money refers to the value of a current amount at a future date based on an assumed rate of return or interest. It helps in estimating how much today's investment will grow over a period. For financial planners, the investors calculating future value is crucial in understanding the outcome of current investment and planning accordingly for future needs. The future value can be impacted by factors like the rate of return and period of investment. Some 15 years back, 20 years back, the bank used to pay huge interest on deposits. Now the rate of interest have come down. Very little rate is bank is paying now. Even in saving bank it used to be 5%, now it is 3%. So the future value can be inspected by factors like the rate of return and period of investment, but it is also influenced negatively by inflation and other external economic variables. In its simplest form, future value is calculated using either simple or compound interest. While simple interest calculates interest on the original principal only, compound interest adds interest to the accumulated amount, making it a more accurate and realistic measure in financial scenarios. Future value calculations are generally divided into two categories: the future value of a lump sum and the future value of an annuity. The future value of a lump sum refers to the value of a single investment made today after a certain number of years at a given rate of interest. Now, calculation of future value we write it as FV, single lump sum, simple interest. FV is equal to principal into interest into rate into time. FV future value, P principal initial amount, R rate of interest decimal, T time in years. Because suppose the rate of interest is 8% per annum, this means yearly it is 8%, and we multiply it by 8 by 100. Calculation of future value, in contrast, the future value of an annuity refers to the future worth of a series of equal payments made at regular intervals. It is often in scenarios like insurance premiums or retirement savings where fixed amounts are deposited periodically. Now, calculation of future value of an annuity is equal to FVA is equal to A into I plus R raised to power T minus 1 divided by R, where FVA is future value of annuity, A is constant periodical payment, R is interest rate per period, and T is number of periods. This is the formula. Now, calculation of future value. Through these formulas, one can determine how much a present sum or series of sums will grow in the future. Higher interest rates and longer investment durations yield higher future values, but also involve, you see, greater uncertainty and risk. You see, the money invested may not come back. Now, present value versus future value. Present value, we write it as PV, is the reverse of the future value. It represents the current worth of money that is expected to be received in the future. Present value is calculated by discounting future amounts using a discount rate, which is essentially the expected rate of return or opportunity. So, for example, if you are having a bill, you see, in that you are going to get the payment after 90 days. You go to a bank and you ask them to discount that bill. So, bank will, you see, deduct its charges and, you see, make the payment to you. Now, after 90 days the party will pay to the bank. So, bank will recover from you 90 days interest, you see, and other bank charges, you see, that bank will recover. The principle behind present value is simple. A rupee to be received in the future is not as valuable as a rupee in hand today. The future in the future, the cash flow is expected, the less it's, you see, worth today. Present value is widely used in real world applications, you see, such as valuing investment, you see, projects, determining pension values and deciding between lump sum and annuity payments. It serves as the foundation of most financial appraisal, you see, methods, including net present value and discounted cash flow, you see, analysis. Now, present value PV is equal to FV divided by 1 plus R raised to power T, where PV is present value, FV is future value, R is discount rate and T is number of years. This is a formula. Time value of money and its significance. The concept of time value of money is extremely significant in financial decision making because it directs how we evaluate investment opportunities, compare alternatives and manage resources efficiently. Time value of money assists in determining whether an investment is worth, you see, pursuing by comparing the present value of expected returns against the current cost. For business growth and expansion, companies need to evaluate success of finance such as equity or debt, and the time value of money helps in assessing the cost and benefit of each, you see, source. Since future outcomes are uncertain, time value of money offers a systematic approach to account for, you see, time, interest risk and inflation, thereby enabling more rational financial planning. An example that illustrates the importance of time value of money is, you see, comparing two projects. You see, project A proposes a return in the first year while project B offers the same amount in the fifth year. Although the nominal values are, you see, the same, the present value of project A is higher, making it a better, you see, choice. This simple logic underlines, you see, how crucial the time value of money concept is in financial strategy and evaluation. Applications in financial decisions. The time value of money plays a critical role in financial decisions, especially in investment and financing, investment decisions and financing decisions. Investment decisions involve, you see, evaluating whether the present value of expected cash flows from a project exceed the initial investment cost. This requires discounting future cash flows to the present using the firm's, you see, cost of capital. If the net present value is positive, the investment is considered viable. For instance, if a project costing rupees 1 lakh is expected to generate, you see, cash flows that are, you see, worth only rupees 92,000 in present value terms, it should be rejected as the return is, you see, insufficient to cover the cost. Financing decisions. In financing you see, TVM is applied to evaluate the cost of raising capital through methods such as issuing debentures or taking loans. When a company raises funds today, it commits to future cash flow, you see, outflows in the form of interest and repayment. These outflows must be discounted to the, you see, present to assess whether the financing, you see, cost is justified. The analysis helps in deciding whether to issue new debt and at what, you see, terms. The time value of money is, you see, cornerstone of financing management. It reflects the principle that money available now is worth more than the same amount in future due to its potential earning capacity. The concept is applied in all, you see, major financial decisions such as investment evaluation, project selection and financing alternatives and retirement planning. You see, when you retire, in many offices, you see, they give you pension also. Otherwise, you see, if there is no pension, they will give you provident fund, your contribution, their contribution plus gratuity they will give you. They will give you encashment also. So now after that you have to plan in such a way that every month, now there will be no, you will not be getting the salary because you are retired. Every month from these funds you get so much interest so that you can, you see, easily, you see, pull on. So time value of money is a cornerstone of financial management. It reflects the principle that money available now is worth more than the same amount in future due to its potential earning capacity. The concept is applied in all major financial decisions such as investment evaluation, project selection, financing alternatives and retirement, you see, planning. It helps in comparing cash flows, you see, occurring or at different, you see, times by converting them into present, you see, or future values, you see. Mastering, you see, time value of money, financial efficiency and, you see, profitability. So in this particular, you see, unit, what we saw, small unit, we saw time value of money, we saw, you see, future value. What is future value? The future value of money refers to the value of a current amount at a future date based on the assumed rate of return or interest. Then you see, we saw calculation of future value, we saw the formula. Now the formula is future value is equal to P into 1 plus R into T. FV is equal to future value, P is the principal, R is the rate of interest and T is the time. Then we saw how to calculate future value. Then future value, you see, future value of an annuity, FVA is equal to A into 1 plus R raised to power T minus 1 divided by R. This is future value of an annuity. Then we saw comparison present value versus future value. Then we saw present value versus future value. Present value is equal to PV is equal to FV divided by 1 plus R raised to power, you see, T, where PV is equal to present value, FV is future value, R discount rate and T number of years. The time value of money and its significance we saw then. Then application in financial decisions, we saw investment decision and financing decision. Investment decision involving whether the present value of expected cash inflows from a project exceed the initial investment cost. Then financing decision, in financing, you see, time value of money is applied to evaluate the cost of raising capital through methods such as issuing debentures or taking loans. When a company raises, you see, funds today, it commits to future cash flows, you see. in the form of interest and repayment. It commits to future cash outflows in the form of interest and repayment. These outflows must be, you see, discounted to the present to assess whether the financing cost is justified. The analysis, you see, helps in deciding whether to issue new debt and at what, you see, terms. What are going to be terms and conditions. Then you see we saw the summary. In the summary we saw time value of money is a cornerstone of financial management. It reflects the principle that money available now is, you see, worth more than the same amount in future due to its potential earning capacity. The concept is applied in all major financial decisions such as investment, evaluation, project selection, financing alternatives and retirement planning. You see, it helps in comparing cash flows occurring at different times, you see, by converting them into present or future, you see, values. Mastering time value of money enables more accurate and informed decision making, thereby enhancing, you see, financial efficiency and profitability.